Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Welcome to another ASST analysis. This time, we're going to be analyzing the company stock from a couple of different perspectives. Strive Asset Management, or ASST, has gone through this really fascinating and, complex transformation. It leveraged a reverse merger to become a Bitcoin treasury company, and it's explicitly trying to follow that MicroStrategy, that MSTR blueprint. They're now holding 7,525 Bitcoins and operate under a pretty specific Bitcoin hurdle rate investment philosophy.
And the market's reaction to that pivot has been, volatile is putting it lightly.
Absolutely. So given the extreme short interest, which on paper looks to be far greater than the entire public float, and the stock's just highly erratic price action, we're left with a really stark central question. Is ASST primarily a structural play that's positioned for this massive technical upside, maybe a 5x return, up to around $4.40? Or is that potential just fundamentally capped by the huge shadow of future dilution?
I come at it from a different way. While the technical setup certainly makes for sensational headlines and a lot of high-risk excitement, I really believe the valuation is mathematically constrained by structural issues. My perspective is that the massive future dilution risk, specifically this wall of hundreds of millions of warrants exercisable at 135, just renders any sustained major move upwards virtually impossible. And that high short interest you mentioned, while it's numerically staggering, it's fundamentally misleading. It signals a sophisticated, hedged trade, not a traditional short squeeze.
Okay, so I'm going to argue that the technical factors and the current market structure, what we're calling the float trap, create a very viable pathway for a rapid, really volatile price spike. This is what I'm calling the liquidity crisis case.
And I'll be arguing that the boxed short dynamic, combined with that structural dilution wall at $1.35, is the gravitational anchor that just prevents any kind of sustainable escape velocity.
My position really rests on the capital structure disparity, and this is where the extreme short interest analysis has to begin. We're dealing with, roughly 815 million total shares outstanding, but the supply shock comes from the free float, the shares that are actually freely tradable. And that public float is only about 15.11 million shares. It's an artificially induced scarcity, a true float trap that was created by the reverse merger structure.
It is bizarrely lopsided. You're right about that.
And this scarcity is what has twisted the market structure into this dangerous anomaly. The reported total short interest stands at an alarming 88,975,355 shares. So when you compare that, let's call it 89 million short position, to the 15.11 million public float, the short interest is mathematically over 5 times the readily available supply. This extreme market structure creates a potent risk of a gamma squeeze. We've seen the Fintel squeeze score reflect this technical risk. It's sitting up near 98.
Okay, let me just pause you right there because I think focusing only on the sheer number of shorted shares misses the most crucial mechanism at play here. For anyone just looking at headlines and seeing 5 times the float shorted, you have to understand this is a hedge. It's not the typical directional bet that you're used to seeing. I'm sorry, but I just don't buy that the headline short interest signals a traditional short squeeze risk.
So, okay, but why isn't 89 million shares shorted against only 15 million available? Why isn't that a huge squeeze risk?
Because, and this is the key thing, the reason for the shorting explains the stability of the sellers. The 88.9 million shorted shares are not indicative of investors betting directionally against Bitcoin or ASST's strategy. This high short interest is the result of what the market calls the boxed short arbitrage thesis. You have these large institutional investors, the PIPE participants, the funds that bought into the company's structure early, and they're holding massive restricted long positions. Specifically, they hold shares, and more importantly, those overwhelming 555 million warrants exercisable at $1.35.
And they're using the short side to hedge their long exposure while they wait for liquidity.
Precisely. They short the common stock in the open market to lock in a profit spread between their low-cost acquisition price, around that 135 warrant strike, and whatever the current trading price is. This is a structural hedge, and its existence is, it's empirically confirmed by the anomalously low cost to borrow, or CTB.
And for our listeners, the CTB is essentially the daily fee short sellers have to pay to borrow the shares.
That's right. And that rate sits at only about 2%. If these were truly directional short sellers facing imminent margin call risk because the stock moved against them, the CTB would be dramatically higher. I mean, we'd see rates north of 100%, signaling desperation and scarcity in the borrow market. The fact that the rate is 2% means these short sellers are not forced buyers. They have a guaranteed locate through their restricted assets, essentially making them immune to traditional short squeeze pressure.
Okay, the CTB evidence is compelling, I'll grant you that. The institutional shorts aren't panicked. They are stable, rational actors locking in arbitrage. That said, their stability is irrelevant if a market maker is forced to panic buy to hedge their options exposure. That's where the technical opportunity lies.
How can an outside technical force override the institutional stability of the boxed short?
The core issue remains the extreme scarcity of those 15.11 million shares in circulation. Even if the 89 million short position is hedged, that tiny available float means the stock is hyper-susceptible to algorithmic control and, let's be honest, manipulation. We see this in the price action, the phenomenon that retail traders see all the time, what they call barcoding, those long periods of flat, choppy trading just suddenly interrupted by 10, 20% spikes. That is classic evidence of high-frequency trading interacting with thin liquidity.
So you're arguing the lack of float allows technical triggers to completely dominate the fundamentals.
Exactly. This environment of thin liquidity is precisely what enables these non-fundamental price spikes. The key here is the interaction between retail buying call options and the corresponding options hedging by market makers. When a market maker sells a call, they're structurally short volatility and they have to hedge their position by buying the underlying stock. That's positive gamma exposure. So if a surge of retail buying forces the market makers to hedge into that thin 15 million share float, that buying pressure just completely overwhelms the immediate supply. The forced buying that follows is what kicks off the liquidity crisis case. It's an acceleration mechanism.
I see why you think that, but let me give you a different perspective. Even if that gamma hedging pressure is intense, it still runs smack into the hard ceiling of the warrant wall almost immediately. The 555 million warrants at $1.35 represent a definitive, mathematically defined cap on any sustainable price movement. The arbitrage funds aren't just sitting idle. The moment the price meaningfully crosses that 135 threshold, their incentive to exercise those warrants and sell those shares increases exponentially. And that introduces a massive wave of supply to cover their shorts or just realize profit.
I'm not convinced by that line of reasoning because technical pressure can temporarily override structural constraints. The liquidity crisis case relies on a very specific, very short-term condition. The window of maximum volatility exists before the SEC resale registration is effective, and those 555 million warrants are actually tradable. A transient spike to 440, the 5x target, is technically possible if retail buying, fueled by the options market, overwhelms the float before that institutional supply can be legally deployed. The spike is a race against an SEC filing.
I mean, that's a fascinating, high-stakes hypothetical. But institutional arbitrage funds are not passive. They know this risk. They are actively monitoring the price action to strategically sell their common stock longs against their warrants. The warrant wall isn't a temporary inconvenience. It defines the long-term dilution risk, and it serves as a powerful gravitational magnet for the stock price. Those 555 million shares represent a supply overhang that, when it's fully deployed, just balloons the total share count dramatically.
But if the spike happens quickly, say over a single volatile week, the institutional arbitrage players with restricted shares are often legally prevented from selling until the prospectus and registration statement are finalized. That's the critical time delay.
The problem is just the sheer scale. For the stock to sustainably trade above 135, the market has to absorb over 500 million new shares. That's a minimum of $750 million worth of selling pressure from the restricted holders, and that supply will break the float trap forever. Furthermore, if you model this out fundamentally, the 5x target is mathematically unreachable even under heroic assumptions.
How so?
Well, scenario modeling based on fundamental appreciation just reinforces this hard cap. Let's imagine a truly massive, unprecedented Bitcoin supercycle, where Bitcoin hits, say, $250,000. Under those conditions, AST 7,525 BTC holdings would be worth significantly more, sure, but you have to account for the full dilution. Once those warrants are exercised, the total share count would balloon from 815 million to nearly 1.4 billion shares.
A colossal number.
Exactly. And when you divide that massive Bitcoin value by 1.4 billion shares, the resulting implied share price would still hover below $3, probably around $280, even in that bullish extreme. That is so far short of the 445x target. The existence of these warrants means that the market is structurally prohibited from pricing ASST like a standard, undiluted treasury company.
I'll concede that the mathematical long-term cap is clearly defined by that 1.4 billion fully diluted share count. That is a difficult barrier to overcome through fundamental appreciation alone. But let's pivot back to fundamental viability, because the high cost of capital is arguably a deeper structural flaw than the dilution wall itself. It places the entire operational strategy under immense pressure.
Agreed. We have to address the company's financial health and its cost of capital. This is where the contrast with MicroStrategy, their supposed model, becomes just stark. MSTR has a huge competitive moat because it's able to borrow at near 0%, typically less than 1% for its convertible notes. ASTST, however, is financing its Bitcoin accumulation through a specific class of SATA preferred stock, which carries a crippling 12% dividend.
12% is astronomical in the current financing environment, especially for a treasury operation.
It is incredibly expensive capital. For the ASST strategy to simply break even, not grow, just maintain, Bitcoin has to appreciate by more than 12% annually just to cover their financing costs. If Bitcoin nearly trades flat for a year, ASST bleeds 12% of its underlying capital base, which highlights this severe dependency on the macro crypto cycle. MSTR just doesn't face that kind of existential pressure.
That high hurdle rate does explain the focus on their Bitcoin hurdle rate philosophy. They're forced to be aggressive just to overcome this cost of carry. However, the market already recognizes that 12% financing cost, yet the valuation suggests it's willing to tolerate it. ASST currently trades at a premium to its raw net asset value of its Bitcoin holdings.
A thin premium, often just based on the extreme short interest and volatility.
But this premium suggests the market is paying for the expectation of accretive growth and strategic execution. Management is actively exploring non-dilutive acquisition strategies precisely to increase Bitcoin per share and eventually overcome the pressure from that 1.4 billion fully diluted share count.
What kind of non-dilutive strategies can meaningfully move the needle against such a massive dilution wall?
Well, they're exploring M&A to acquire cash-rich treasuries that can then be converted to Bitcoin without issuing new stock. They're also leveraging complex financial instruments like Section 351 exchanges. For those unfamiliar, a Section 351 exchange lets large holders, usually institutions, swap large blocks of Bitcoin for ASST equity on a tax-free basis. If ASST issues new shares in these exchanges at a high valuation premium, it effectively increases the Bitcoin per share for existing holders without the harsh drag of that 12% cash dividend.
That's certainly a theoretical path, but the execution risk on complex M&A and specialized tax exchanges is significant. And until those strategies bear fruit, ASST is functionally just an expensive leveraged option on Bitcoin. It has the same directional exposure as holding Bitcoin directly, but with a built-in 12% structural drag and an intrinsic ceiling defined by that $1.35 strike price.
The premise is that the market is willing to pay a premium for the potential execution of those strategies. The current valuation, thin as that premium may be, reflects that hope. But even if we discount the long-term viability, we can't dismiss the immediate technical reality, which is driven by dark pool trading analysis.
We talked about the barcoding, but how does dark pool trading specifically influence that tiny 15 million share float?
Thinly traded stocks like ASST are routinely used by algorithmic funds for dark pool trading. This allows large orders to be executed without immediately impacting the visible order books.
But when you have only 15 million shares available for the public to trade, any small influx of directional volume, which the dark pools eventually have to clear, can create these exaggerated price responses in the lit markets. This interplay between highly controlled dark pool volume and the extremely thin lit float is the engine that drives those sporadic, dramatic intraday moves.
So you view the current price as less a reflection of value and more a reflection of manipulated kinetic energy.
Precisely. The analysis confirms ASST is a game of extreme technical volatility driven entirely by the artificially small free flow of roughly 15 million shares. I believe a technical spike to the 5x target remains a moderate but real risk. I'd put the probability at maybe 20 to 30%, purely due to market structure and the gamma exposure created by options trading, irrespective of fundamental value.
Ultimately, for me, the structural constraints are overwhelming. While ASST is a fascinating financial experiment, that deceptively low CTB confirms the boxed short mechanism, and the overwhelming 555 million warrant overhang at $1.35 means that any technical volatility event, no matter how explosive, will simply be a sell-the-rip opportunity for restricted institutional holders. The structural limits dominate the theoretical technical upside.
And I would agree that any rapid price spike would be transient and driven by market structure, not fundamental viability. Sophisticated investors have to recognize such an event would be a prime opportunity for institutions just waiting to offload their restricted shares. This is a volatility trade, not a strategic long-term hold, and the clock is ticking against that structural supply wall.
And recognizing that this complexity requires multiple perspectives to fully appreciate the risks, the operational hurdles, the financial costs, and the cold, hard mechanics of capital markets is essential for any investor engaging with this highly leveraged instrument.
Indeed. Understanding that interplay between operational pivots and capital market mechanics is really what separates sound analysis from mere speculation in this unique and, very challenging structure.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.